Finding the right price to buy a stock or the right time to sell it is a very, very tough task for any investor. In this video, we'll discuss 7 rules, 10 factors, and 9 basic elements that determines your stock market investing. These are the basic things you should know before you start your stock market investment journey. So like and subscribe this channel right away so that this video reaches a lot of people. So let's jump straight into the 10 key factors before you start your stock market investment journey. Number 1 is the time horizon. See, time horizon, basically you can divide this into 3 phases. Less than 1 year is a short-term investment, 1 to 10 years is a mid-term investment, and anything more than 10 years, you can consider it as a long-term investment. So any investment you do, first you need to determine, do you need this money in short time? Do you need it in a mid-time? Or do you need it beyond 10 years? If that is clear, then you should proceed further with your investments. So first point is to make this point very, very clear. When do you need your money? When you need your investments? The reason why you're investing for. Number 2, investment strategy. Passive investing, active investing, growth investing, value investing, income generating investments. What is it that you want from your investments? What is your goal? What is it that you're looking forward to from your investments? Number 3, the buy and the sell price. See, the first ask is always to buy the stock at the right price. But what exactly is the right price? See, the basic answer to this question is different for different investors. But there is one very, very common answer, which is your buy price should be less than the price you want to sell it in future. That's as simple as that, isn't it? Now, having said that, I mentioned that my buy price should be less than the selling price. If that is the case, what is my selling price? Have I seen the future? No. Then how can I determine what's going to be my selling price? What's going to be the price in future? How do I know the selling price? It's true. The question is right. We cannot determine the future. We have not seen the future. So predicting a future market price is very difficult. But we can go very, very close to it by doing a thorough calculation, by understanding the stock and its parameters, by looking at the future performance of the company and also the financials of the company. All of this we'll discuss more in details when we do our fundamental analysis and the technical analysis classes. But as of now, yes, we can go very close to it, but absolutely certain, we cannot be absolutely certain. Well, there are many ways to determine the future value of a stock. One of the most commonly used is the intrinsic value calculation. With that, you can go very close to it, which will help you determine whether you should consider buying the stock or not. It's just whether you should consider buying it or not. Once you consider, okay, fine, I can have a look at this, then your next steps come into picture, which involves other fundamental analysis study. Number 4, your stock performance versus the competition. What the competitors are doing, how are they performing in the market versus the stock that you have chosen to buy. This is a very important factor to look forward to. Number 5, shareholding pattern. A shareholding pattern gives you an insight of how well the foreign institutional investors, the promoters of the company, how they value their own company. If the promoter holding of the company is good, if the promoter holding of the company is increasing, which means the promoters have a good faith in their own business, in their own company. They know what they're doing. If I have foreign institutional investors, how much have they invested in this company, in a particular stock, in a particular mutual fund, whatever it is, any security you think of? How are they valuing the company? We as a single individual investor, we get a lot of insight from this data. Number 6, a stock's mutual fund holding. How much percentage of the stock is in a particular mutual fund or in other mutual funds. How many fund houses have purchased this stock? This gives a massive information to a small investor like us, you, me, and anybody else. A good investor or a good mutual fund holding means the mutual fund companies, the AUMs, have faith in this company. They analyze the stock much better than what we can do. The size of the company, it's very important. No small caps, please, unless you are a very experienced investor. If you are a newcomer, please stay away from small caps, because they are, like those Diwali rockets. Either you fire or you don't fire. There is no guarantee. So unless you understand the market thoroughly, unless you know what you're doing, stay away from the small cap. Go with large cap. They are much more stable and will give you a very solid returns for your portfolio. The dividend history of a stock. Now see, I described the type of investing you're looking forward to. So for those who are looking at an income investing strategy, for them, a dividend paying stock is an important asset in their portfolio. The volatility of a stock. This is again a very important factor. The higher the volatility, the movement, the fluctuation of that stock will be very high during market fluctuations. During bear market, it's going to fall down like a rock. During a bull market, it's going to go skyrocketing at a very high speed. Whereas on the other hand, a low volatility stock will be very much stable. It'll definitely move as per the market, but it'll move at a very slow pace. It'll give you the time to come out. It'll give you the time to enter and come out. And then the most important thing is the fundamentals of the company, which is one of the basic elements, or you can consider them as the basic elements of a stock. So what are they? So the basic elements are the PE ratio. So PE ratio tells you how much you're willing to pay for a stock to get 1 rupee in return. Say suppose if you're willing to get 1 rupee for a price of, for 100 rupee price for a stock, which means you're willing to pay 100 rupees to get 1 rupee in return. The debt to equity ratio, it's a very important factor. The higher the debt, which means more of the company's earning would go out as an interest payment. So less of the company's profit will be available for the shareholders. So it's very important to watch out for this ratio. How much debt to how much equity you have. It's desirable if you have it less than 1, or at least at the most a ratio of 0.5 is okay. So the lesser the debt, it's much better. 0.5, 0.4, 0.5 it's fine. But anything beyond that, it's going to be a little bit risky. You need to scrutiny, you need to analyze the stock further before you plunge in. The price to book value. This compares the stock price to the net asset that the company has. It's again a very important factor, which we'll see when we do the fundamental analysis. This tells us how, where the company stands in terms of its pricing versus the actual asset it has. The earnings of a company. This is again one of the most important factors, because if the company doesn't earn money, it's not going to give benefits or returns to the stakeholders. Why should you buy a company like that? So earnings of a company should be consistent, or at least in an increasing trend on a year-on-year basis. So every year, if you see the graph is moving up for the earnings, that's a good sign that the company is making profits. Although this might not be the best metric to judge a company or its performance, but still it's advisable to buy a company that has a growing earning every year, or at least it matches the competitors, or the similar company in the same business venture. Your company should have an earning which is close to what your competitors are earning. Free cash flow. This is again an important parameter. It tells us how much of an extra cash the company holds with itself. This cash can be used by the company to pay out as a dividend, or the company can reinvest in itself to grow further, to become big, to buy in more assets, to bring in more business and perform and grow bigger as a company. So the more the free cash flow, the better. You need to see these numbers in the balance sheet. This tells us how much the company is utilizing its cash flows, what the company is doing with its cash flow. The free cash flow to equity. This is a very important factor which tells us the company has an advantage over its competitors. This is a better measure of company's actual equity and its economic value to its investors. The return on assets. Strong companies do have a good ROA compared to its competitors. This tells us the efficiency of the company in generating earnings. The return on equity. Now, we discussed the return on assets, but what happens is many companies, they generate return based on debt. They take in a lot of debt to generate more income. This parameter will tell us how much return the company is actually generating as on its equity alone, not on the total asset. So return on asset does give us a value, but that is not sufficient. ROE, which is the return on equity, it determines how the company uses debt to generate income. An unusually high ROE can be a red flag for further investigation. So if it's very high, do check again. Should you invest? Net margins. Net margin is nothing, it's net income divided by sales. What does this give us? This gives us how efficiently a company is bringing in profits from its sales. Now, there is no set parameter as to like this percentage is good, because for different businesses, the ROE or the net margin is very, very different. Say like for groceries, it's very low because the margin is very low in that business. Whereas in software, the margin is very high. So now we have seen all of these, what is required to be in the market, what are the things you should look for, what are the things you should scrutinize, analyze, and then finalize on buying a stock. Now let's wrap up all of these with the 7 rules which you should follow. Rule number 1, never invest in a business which you do not understand. It's a very, very known statement from the legendary investor Warren Buffett. That's what he says. It's what the world should follow. We should never, never, ever invest in something which we do not understand. It may be good. I'm not saying it's bad. It's something which you do not understand. So stay away from it. Number 2, understanding the financial ratios. We have seen the financial ratios, a little bit, but we'll go deep into details when we go through the fundamental analysis classes. But yeah, this is an important factor which tells us about the stock and whether you should be investing in it or you should be staying away from it. It gives us the numbers. Watch out for the value traps. Value traps are, as we say, traps. You should watch out for these. Many a times you will find a company is valued very, very less. You should immediately think, why is it valued so less? Why the value of the stock is so less? What is in it? So the primary reason is the value is less because there is some problem with its company. That should be the first point that should come into your mind. And then that will trigger you to investigate further and drill deep into what's actually there in the company. What's the fundamentals? Or how the management is? What is the competitive advantage that the company has in the market? Does it have any or not? All of these factors, these are the factors that brings the value of a stock down or up. We, me, you, me, and many like us are individual retail investors. The amount of knowledge, insight, or information we have access to is far less than what big corporate houses, big businesses have. So if big businesses does not value a company much, it does not give value to a company, the price of the company is not much, there is something wrong. Many a times, investors like us, we run after small price stock. Okay, we say, oh wow, a company is such a big company, the price is so less. Wow, let me buy it. You can. Definitely, if a renowned company the price of a renowned company is less. It's okay to buy. But it's okay to buy only after you do a thorough research on that company. The promoter might be good. The person managing the company might be a big businessman. The other companies that he owns might be doing very well, but not this particular one. So it's just because the owner of the company is known to you, it's one of the richest man in the country, in your country, it does not necessarily mean that this company is going to do well. His other's company might have performed well, but may not be the one with this one. So avoid these value traps. Don't fall for a company just because the owner of the company is known to you. You know this person. You know this person owns another company which is huge. Just because he owns a huge company does not necessarily mean the other company that he owns will also be very huge or will also be good. It may be good. It may or may not be good. You should analyze it and then invest. Avoid chasing high yield companies, high dividend yield companies. There are companies which gives out tons of dividends, but the company fundamentals are gone. The business scope, the future of the business is gone. It's giving out dividend because it's earning as of now, but no one knows there is no future in this business. You should understand the future of the product a company is bringing out. Does this product have a future? If this product has a future, then this company is going to survive. If it doesn't have a future, probably maybe a year, 2, 3, 4, 5 years down the line, this company is going to go out of business completely. No matter if it pays out 10, 20% dividend yield, doesn't matter. So beware of these high dividend yield traps. Checking the promoter activity. See, the insiders of the company, they know the best value of their company. Look out for what they are doing. Are they buying their company shares by themselves, or are they selling off? Are they liquidating their own holdings? Look at these buy-sell patterns, the option strategies that they have. Check for the insider transaction these people are making. Number 6, the economic moat. A moat is, you can consider this as a barrier outside your company. This is my company. I have a fence outside my company. This fence will protect the competitors from entering my business area, my market area. Do I have a moat? What is a moat? Something which does not allow the competitors does not even come closer to what you produce in the market. If you are into a food business or something, edible, the taste that you produce is unmatched. No other player in the market can match or even come closer to the taste that you produce in your for the food that you produce in your company. If you're in a technology company, the technology, the product, the pricing that you keep for your technology, the pricing that you keep for your product, or the options that you give to your customers, the convenience that you give to your customers from your technology is unmatched. No other company can give you or give the customers that kind of convenience, that kind of security, that kind of easiness in handling their day-to-day lives using your technology. And that keeps your moat, that keeps your company inside the fence, safe, sound, secure for a very long time. And when that happens, you continue to earn a lot of money from the market. The reason, there is no external intrusion. There is no competitor who can enter the market and take out your business. It cannot happen. Or it's very difficult to happen. So that is economic moat. Check out for those moats. We need to check out if a company that you have analyzed and you have almost finalized to buy, does it have a moat? That's an important factor. Number 7, the market risks. See, all stocks have risks in the market. Be it a very stable large cap company or a small cap company, everybody is exposed to risks. Now, what kind of risk is okay for you is what you need to check. Here comes the beta value. The beta value of a stock gives the sensitivity of the stock compared to the market. The market has a beta of 1. What is the beta for your company? What is the beta for the company that you have chosen to invest in? Any value of beta more than 1 would indicate a higher volatility stock. Anything less than 1 would indicate a lesser volatile stock. So these were the 7 rules, 10 key factors, and the 9 basic elements which you should know before you plunge yourself into stock market investing. We'll go deep into it and we'll understand stock market investing in details when we do the fundamental and the technical analysis. So these are some things which you should keep in mind if you want to be in the stock market. So that's all for today. We'll not extend this video further. See you again in the next video. Till then, SG signing off. Goodbye.